Okay, now we proceed to financial management. So financial management from the results that we see from students it's a bit of a challenge, and it's a bit of a challenge because it's very broad. It's generally very broad principles that you have to apply as necessary in the question. So generally, students struggle more with financial management than with costing. Because costing has formulas that you can use, and you can get things right. But with financial management, it's a very broad, module, and students generally struggle with them. But it's very easy though. But all right, so let's see what we're going to do here. No, I'm not going to do by. I'm not going to start by discussing things in general. All right, I'll just include the general aspects when we're answering the questions. Right. So the question requires us to, the required part will require us to. Right, for the start, we are required to it's not here. Discuss 5 key risks evidenced from the scenario that an entity faces, and then briefly discuss how each of these can be mitigated. All right. For each risk discussed, you must also identify the risk category. So this is for 10 marks. And I always say to you that these questions where you have to do a discussion, a general discussion, right? You must take these questions very seriously. And the reason why you must take these questions very seriously is that they are scenario based. There is no principle behind you. There is no correct answer. There's no right answer or wrong answer. Right? It's about how you formulate your answer. That's all. So basically, the lecturers might provide what they think are the key risks, maybe 10 or more, and then they will always say then whatever else the student provides, which is reasonable. So you need to take these questions very seriously. And I've repeated in class many times that when you answer questions, you must start with these ones. Right? And the reason why we do that is because you don't want to run out of time and lose marks, which you can get. Because for this one, you can get 10 out of 10. The reason being, you don't have to have studied that. There's no principle, but there's a technique that you have to follow in identifying the risks. All right, and it's up to you how well do you think. All right, so it's very easy for you to come up with 5 risks, then discuss ways in which they can be mitigated, and that's going to be very helpful. So when we talk of risks, right? So when we talk of risks, we basically let's talk of risk analysis. We're basically interested in models that help us to identify risks. So we have what we refer to as a SWOT analysis, and we also need to look at the business model. We can use the PESTEL, we can use Porter's 5 forces model. And these are going to help us identify risks in a given scenario. All right. For example, the SWOT analysis is going to help us to look at the strengths of a business and the weaknesses of a business. Then the opportunities in the external environment and the threats in the external environment. So if we look at risks, we obviously want to look at the weaknesses in the internal environment of an entity. And we also need to look at the threats in the external environment, right? And for us to do an analysis of the threats in the external environment, we can look at, we can use the model called PESTEL, right? We can also look at the business model of the entity. And we can also look at Porter's 5 forces model. So what I'm going to do is just to give you a quick summary, but these are things you need to refer to from the textbook or from any other source. Or you can also use the notes that we provided you. We did provide you with the notes and an exercise on risk analysis, right? So the business model, we said that you're going to look at who are the customers. Where are they located? What do we provide those customers with? What are the products that we provide the customers with? Who are our suppliers? Right. So you can use Porter's 5 forces model to analyze the risks associated with suppliers and customers. How do we deliver the goods or the products that we're offering? What's the mode of transfer? Is it online? Is it by rail? Is it by sea? What are the risks of all that? And then we also look at the industry. All right, is it going to be easy for industry in terms of competition, substitution of products, and so forth? For example, if we look at customers, you might have a high number of customers. Let's say a high concentration of customers. I mean to say concentration risk. For example, when we talk of concentration risk, we're saying that you have, let's say, you have let's say we have 3,000 customers, right? But 10 of these are in China, all right, for example, and they account for 90% of your sales. So obviously that's very tricky, because the moment this business in China goes down, then you have we could say a high value of their contribution there. So you could look in terms of the concentration risk of customers or the concentration risk of suppliers, like you have only 2 suppliers. And if that does happen, that they want to increase the price, then things are going to go up. So that's a kind of analysis in terms of your customers. How much power do they have? Can they demand that your prices go down? How easy is it for industry for other players to enter into the industry and strip of you of your profits, right? What are the products being delivered, and do we have substitutions for those products? So there's a lot of ways that we can look at identifying the risks and ways of mitigating them in a scenario. For example, the mode of transfer. If you're going to be, for example, if your customers are going to buy online, let's say it's an online business like Takealot, and then you obviously need to think in terms of what is this thing called, cyber attack, right? Because maybe they're gonna log in there, steal customer details. Maybe they can log in there, steal money from their customers based on the information that they submitted. Maybe there's gonna be a breakdown of the internet platform, all right, and then the customers are gonna have losses. So you're gonna look at all those risks, right, in terms of, so we have spoken of the SWOT analysis business model, Porter's 5 forces model. Then we can also look at PESTEL. It's going to help us look at pinpoint some of the key sources of risks in the economic environment. For example, we can look at the politics. How can politics affect our operations? How can the economy affect the operations? And remember, PESTEL is not just for threats only. There's also opportunities in the environment. But in this case, we're looking at threats because we want to look at the risks that the social environment poses, the social media, maybe technology, right? What dangers does the technology There could be evolution of technology. So some products that we offer might be obsolete, or customers might prefer online instead of brick and mortar stores and so forth. You also look at what is this E for? Environmental as well as legal. So you have a way of looking at all those, and you combine them into a way of extracting what could be the risks in a given environment. Right. For example, let's say that someone is buying from China, right? Then you could think in terms of the exchange rate. Then you could think in terms of sea piracy, the sea robbers, right? There could be that piracy, and right, they capture the ship that has your stuff, and your customers don't get it. So, and what you're gonna do with that? Then we can talk in terms of geopolitical tensions, where there could be sanctions on this and that, and then you're not allowed to do business anymore, right? And then we're going to take in terms of delays in transportation. For example, there's going to be a delay in the Durban port or the Transnet and so forth. So you look at how the business model is done. When we talk of the business model, we're referring to what the business offers its customers, and why would customers want to do business with that particular business, all right? So we look at from the start, what are you selling? What products are you selling? How do you bring those products to the customers? Who are your suppliers? What are your supporting mechanisms? So the whole business model is what we will be talking about. So that's a very broad question, and I have said to you consistently, all right, I want you to start answering this question, because it's an open question. And if you apply your mind, maybe 15 minutes, why I want you to start with these questions is because you can get 10 out of 10 when you get your mind together, right? And really think. No one can just come and say, this is wrong, because it's your ideas, and as long as they are reasonable, it should be possible for you to get them out. And because they say discuss 5 key risks, I think it's wise maybe if you can put in something like 7 or 8 risks, right? Because there's a good chance that they will also consider, they will also consider when they might look, for example, this is an examiner or a marker looking at you and say this is not quite good, but they might go to the next one until they get 5. I do not know how the actual marking is done, but there's always that possibility where you don't get the first one right, and then you can get the second one. So you don't have to restrict yourself to just 5. You always try to be maybe 6, 7, maybe 8, right? And then we also have risk categories. So this is what I got from the textbook, I think. So we have business risk. So business risk has to do with trading risk as well as operating risk. So trading risk is the risk that has to do with buying and selling, right? So it has to do with our customers and our suppliers. Then operating risk has to do with all the other stakeholders we deal with, like your labor, your employees, your other platforms, your employees, your trade unions, your government, your electricity, your other suppliers, right? So that's the business risk in your trading and in your operations, right? Then you have financial risk, has to do with your source of funding. Do you have preference shares that are foreign denominated? All right. So maybe if there's going to be an appreciation of the dollar, then you might see fires. You might see flames. So do we have let's say we have a loan that is due at the end of the year, all right? So, and we have to repay the full amount of the loan. We will have the sufficient monies, so that's going to be liquidity risk, right? Do we have a facility, a borrowed facility where that is sensitive to interest rates, so that it could fluctuate in line with the interest rates, and then the interest rates go up, then we're gonna be in trouble. Do we have assets that we acquire for trading, and then those assets prices can go up or down? So that's your financial risk. And then I see here there is also legal and compliance, which is very important. So you can look at that, and then operational risk. So the question says the identify which risk category. So that will depend on the risk that you run. For example, if there was a potential risk for competition, that new customers, new suppliers can come up with more innovative ways of delivering the product to the customer. So that would be competition risk, and that would be a business risk, right? And then how do you avoid the competition risk, or how do you mitigate that? Then you might need to do a competitor analysis to understand the strengths and weaknesses of your competitors, right? And then with that, then you can come up with ideas that that can counter the potential threats from your competitors. Maybe you can do a consulting work. You can hire outside consultants to help you devise international best practice operations. So if you talk of maybe it's a reputation, because there could be some let's say there is a failure in something. I haven't read what is happening here. I haven't read the I haven't read the background to the company, because that's not what we want to discuss. I want to discuss the general principles, the general thing. Let's say here, I think it's a TV, and then there's negative publicity, right, about that TV, and then that's going to be reputation risk. So you might need to hire experts to help you manage that negative publicity as a mitigation. Right, so please do remember to pay very good attention to these questions. I said these questions have to do with risks. And what is that other concern again? So there are risks. Then there are qualitative considerations in decision making, because then you're going to have a quantitative calculation that points you in some way. And then what else are you going to consider before you make the decision? So that will be your qualitative or non-financial factors. I said you must pay attention to this. Then then these risks, we said the risks could be business or financial risks. All right. I think we also spoke about all right, no, these were just risks. I think then we also spoke about is this there's something called social, ethical, or environmental, social, ethical, or environmental considerations that you might have to apply in a particular scenario. And I've said to you, I want you to look for questions that address these things in the question bank. In particular, then you write down the questions, you write down the answers, then you have kind of an idea of what type of points can you raise. You will always raise points in line with the scenario. But have a look at questions in the question bank where we discuss the non-financial factors, where we discuss the qualitative factors. And that will help you to have an idea of what type of points can you raise. Because this is very important, they will give you a lot of marks and you can take all the marks. With other questions, it may not be possible to collect all the marks because you will make mistakes in principle and everyone will see that this is wrong. But with questions like this, they are open. You can just construct your reasoning properly, then collect all the marks. Right. Then the other question, where is the other question here? Then we do a performance of a revenue analysis for short time by calculating 6 subscription fee related ratios only and providing practical reasons commentary for the movement in these ratios between this year and that year. That's quite mean of the lecturers to do that, It's very mean of the lecturers to do that, because then the calculations for 6 ratios is 6 marks. That's then the commentary is 2 marks. And when I look at this, I think this is not a fair allocation of marks, because the first thing you have to do is to think which ratios to do. You have to actually come up from your head Then after that, you do the actual calculation for 2023, right? You need the formulas, right? You need a formula, and then for you do the actual calculation for 2023 and 2024. And for you to get 6 marks for that is not fair. At least if you were given the ratios to calculate. Yeah, but then these are some of the questions that are also very easy, but can be very difficult. If you then get stuck, obviously that will be very difficult. So when we analyze something, right, any analysis, any analysis. So let's talk of a ratio analysis in general. In ratio analysis, we can talk in terms of the growth, right? The growth of a ratio from 1 year to the other. So we can talk of the growth or change in the rate or whatever, right? Then we can also look at the revenue per something that is relevant. For example, when you look at revenue, you know that revenue is a result of a lot of things coming together, right? So you want to probably see, you have a look at what's the impact of each of those variables that result in revenue. For example, to generate revenue, you need a distribution channel. All right, you might need a distribution channel. All right, so you might want to determine how much revenue did each distribution channel generate. Online, how much revenue generated by online sales, how much revenue generated by the brick and mortar stores. Right. Then it could be the employee. If you have because obviously you have employees, so they can help. So you can have revenue per employee. You can have revenue per store. You can have revenue per whatever is. For example, you can have the other things that you can include in your revenue per customer. If you can count your customers. You can have revenue per customer, revenue per province, revenue per nation, all right, per country, and so forth. Because you're just trying to do an analysis of all those things that contribute to your revenue. But this particular question, if you look at the question, it says subscription fee related ratios only. So they have to be related to the subscription fee. So there's a lot of things we would have done in revenue analysis, but we are being restricted to subscription fee related ratios. So let me try to show you what options you had in dealing with this. Right. So there is the revenue that has been broken down, the number of subscribers. Right. So what could you have calculated here? And they say 6 is a lot. They must have said maybe 3. 6 is a lot of them. So this is 2023. This is 2024. Then they say we must do subscription. Let me just remember the question. Subscription fee related ratios only. So the subscription fees. Right, so there's a lot that you can actually come up with. So this is this is 2024. This is millions, right? 23 million. This is the number of subscribers. This is 7.7 million. Okay, brilliant. So there's a lot of things, ratios that you can come up with. You can come up with subscription fee, change in subscription fee per region, right? You can have or growth in subscription fee per region. Is that not so? So we have 2 regions. We have South Africa, we have the rest of Africa. So I'm not sure if that would be 1 ratio or 2 ratios. I don't know. Because if I say change in subscription fee, right, or growth in subscription fee or whatever, then I do for South Africa, then for the rest of Africa. I don't know whether they will say that is 1 ratio or 2 ratios. I don't know what they would do. But for me, I would think that's 1. But right, I'm not the examiner there. Right, so change in subscription fee last year, this current year is 23,764. for South Africa. Right. I can start with the South Africa category. And this last year was 21,195. Right, you subtract 1, and then you obviously want that as a percentage, right? Then you're gonna get whatever you get there. Then you do the same for the rest of Africa. All right, this 21/25. Right, and remember, you don't have to make a comment for each ratio. You don't have to make a comment for each ratio. You can make a general commentary at the end, because if they say 6 marks for calculations, 2 for commentary, then it looks like that's the proper way to deal with that. Right, so something else that I can think about, remember these are open questions. These are some of the questions that they can use to determine plagiarism, because you can't all think the same, so you show a pattern, and that will be interesting. They'll consider that to be interesting, and they check something else again and they see a pattern. So remember we did that question on what question was it? Costing, when we were to do the valuation of closing inventory and fixed manufacturing overheads. So they check those complex things, rather complicated calculations, rather complex calculations, and they check to see if there's any pattern in students. They can always figure out that you guys were following someone, right? So whenever the examiners do examine you, they will give you questions that they will help them to figure out what you guys are doing there. Right, so the change in subscription fee, South Africa, rest of Africa, the same in percentage. And I say to you, I don't know whether this is 1 or 2, right? And then I can have subscription fee per subscriber, right? Subscription fee per subscriber. So I have the 2024 South Africa is this over that. 2023 South Africa is this over that. Then I can see a change, right? Then rest of Africa, subscription fee per subscriber. Then this over that. Then this over that. So I don't know if that will be 6 or if there's still 2. I really don't know. Right, and we told that we must do subscription fee related ratios. So anything that is related to the subscription fee. I haven't read, I'm not going to read about the prices, whether there was a change in the prices or anything, but I'm not going to. So I can look at subscription fee as a percentage of total revenue, all right? Because this is my subscription fee as a percentage of total revenue. And then my total is this one. So I can see whether there was a change, right? I can see whether there was a change or not. So there's a lot of things that we can look at. So I can also look at the growth or change in subscriber base, all right? So change in subscriber base for South Africa and for rest of Africa. So I'm looking at this year it's 7.7. Last year it was 8.1. Then I subtract 1 there. All right, I multiply by 100. Then I'm going to get a change in subscriber. Right, in subscriber, what is that quantity or what? Subscriber base for my customers. Then so there's a lot of things that we can look at here. I can also look at my change in the average fee per subscriber, all right? Change in the or growth in the subscription fee. Then I can look at this here. So my subscription fee for South Africa would be 23,764, right, over 7.7. So this is my average subscription fee for South Africa 2024. Then I do the same for 2023. Then I compare the change in the average fee from 2023 to 2024. Right. Then based on the information that I have read in the question and this, then the information, then the trends that I've picked up in the in the calculations, I can make a commentary. Like for example, I can make a commentary that there was the percentage contribution of revenue to total income decreased from last year to this year, contributing to the decrease in revenue. Why was that? Because maybe the subscription fee fell over the time, or the number of subscribers fell over the time because of competition with A, B, C, D. So as a result, this is what happened. All right, so I don't want to read here. You can pick those things, whether there was competition, what might have led to a particular outcome. So I've explained to you when we were doing the ratios, when we introduced you to ratios. I said to you, ratios is very broad, right? You just need to be able to pick the variables that are related, that interrelate, that make economic sense, that make financial sense. And then you have to determine the relationship, how one contributes to the other. So we also spoke of financial ratios and non-financial ratios. With ratios, then it's all about the scenario. You have to look at what one variable should do to the other. All right. For example, if you talk of let me talk in terms of gross profit margin. So you know that gross profit margin is going to be your gross profit over your your sales, right? Now you have two variables. You have gross profit, you have sales. Now these two variables need to have a relationship, right? So how do they relate? So my gross profit is going to be equal to my sales minus cost of sales over sales. More correctly, it's actually selling price per unit minus cost price per unit over the selling price. So I want to see in my selling price, if my selling price per unit was this, how much of that went to cost of sales? And that's obviously what is left will be my gross profit. So if my gross profit goes down and my gross profit margin goes down, right? There are variables there are possibilities, right, of what might have happened. So it's either that my selling price decreased, right? So my selling price might have decreased and my cost per unit remained the same. So gross profit margin is going to go down. So it's some things you can calculate, because then you can actually come to your income statement, right? So you see the actual income and the actual cost. You see whether there was an increase. So if you can look here, there was a decrease in revenue and there was a slight increase in cost of sales. So it's obvious what happens to gross profit, it's going to go down. So if you calculate your gross profit margin and you see that it has gone down, then obviously you will see that this is the contributing factor. All right, your cost of sales went up slightly and your revenue went down. So obviously that's the reason why your gross profit went down. But now when you account for the reason for the movement in a ratio, when you provide a commentary, you won't just point out to the obvious. You need the reasons behind the obvious, right? So why is it that our revenue might have fallen? Because if you just say the gross profit went down, our gross profit margin went down because our cost of sales went up and then our revenue went down. That's quite straightforward, right? But then we need the reasons why that might have happened. So it could be a case where we had competition, so we ended up reducing the prices, or we had competition and then most of the customers went away. But whereas the customers went away, our price might have remained the same, but then the costs also remained the same. So what that means is we ended up with a lower gross profit percentage because our customers went away and the costs remained where they were. So when you deal with ratios, you need to be able to calculate the ratio and determine the movement in the variables that make up that ratio. Then you relate that to the case study, because the case study will tell you what has been happening, right? For example, so the management is not bothered by the increasing popularity of some other this is that and that and that. So as you can see, there is competition. So that competition might mean that some customers might be leaving their service for alternative products. So now, because you have done a calculation, it has shown you that the subscribers have gone down, the revenue has also gone down as a result. And what could be the reason behind that? So you could see here that there is substitute products. And you know, ratios is the most difficult questions in your financial management, because they are very broad. They are very broad. They just depend on the situation, and nobody can really prepare you for any particular situation, right? But you need to have an idea of how to approach ratios questions. So you can refer to the ratios notes and exercises that we gave you. We also did cover questions about revenue analysis as well. Then we also covered questions about non-financial ratios, which are very, very, very important, and they have to be applicable to that particular scenario. And because it's so open and broad, you know, you just have to be able to think for yourself on the day, because this is very broad. Right, then the next question, let's see the next question here. So calculate the number of decoders stolen. We covered this in, if you look at a question, there's a question in the question bank for costing. I think it deals with dollars, right? It applies plus or minus the same principle. We have covered this when we dealt with our tools and techniques. So so how do we determine that? What was stolen here? So I just want us to go through that again. How much was stolen? Well, it must be here in the information. So the cost of services rendered, let's go to 1.2. So we have decoders, it's 1.2 again, so that's nice. So the cost of services rendered includes the sale of decoders. So the inventory is all decoders, and the purchase price remains the same. So this 1.8 and 1.5 represent decoders physically counted in storage. However, in the financial year 2024, inventory listed, the inventory list is indicated 150 decoders, a higher number than the physical count. All right. So it means that some decoders were missing and not stolen. All right. So it means there's an anomaly. Right. So I think if we can, that's going to be very simple, right? Do we have so the inventory we have, if the theoretical, all right, I was looking for this one. We need to have the gross profit margin. So the gross profit margin is 20%. So this was sold at 2,000 Rand per unit, right? So which means that the cost of each, right? The cost of each, if we sell at 20% gross profit margin, do you remember we covered the concept of margin and markup? So if we sell 2,000 Rand at a gross profit margin of 20%, it means that 80% is going to be cost of sales. So the cost of the inventory the decoders, the cost of the decoder, all right, is 1,600. This is the cost. So if we have 1,150,000 decoders, right, 1,150,000 decoders, each at 1,600, then it means that the value of the inventory should be equal to 1150, right? 123 multiplied by 1,600. I don't know what that is. So it's gonna be 1,840,000,000. All right. When is that? That's the financial year 2024, right? But actually, so which means that we should have the value of 1,840, all right? But we actually have a value of what? 1.8. 1,800 million. All right. So which means that we are missing a 40 million valuation. All right. So the valuation of what is missing is 40 million, but each is valued at 1,600. So we're gonna have 40 million. All right. Each is valued at 1,600. So how many are we missing? So we have 40 million. 1, 2, 3. Divided by 1,600. So which means that we probably lost 25,000 decoders were stolen. All right. Because if we had everything in stock, then the value was supposed to be 1,840, but we only have 1.8. So we are missing 40 million worth, each at 1,600. So that will come down to 25,000 decoders. I don't even know if that is what the lecturers wanted. But from what I looked, me looking at this, this was what I could do. And remember that this concept of gross profit margin, we have taught you those things: gross profit margin, markup, and how they relate with sales and cost of sales. It's extremely important. I think it's a question on Dolax, right? Again, where we had to calculate the budgeted selling price in a case where you can calculate the cost of sales or cost of production. Then based on that cost of production, you apply the gross profit margin applicable to get the selling price, right? You need to be very comfortable to do anything like that. Any calculations involving your gross profit margin and your markup. Then we do have another question. Finance isn't a very friendly module because it's very broad and you can't pin down anything. You can't pin down like this is what you do. Like in costing, you can pin down a calculation of break even or contribution. You can say this is what you do. But with finance, it's so broad that it's difficult. Then we need to identify with motivation, all right, short times ordinary dividend payment policy, and comment on the future sustainability thereof. So no calculations required, just 4 marks. So that is very easy, but it's not really easy if you are not prepared. Then, so let's look at the ordinary dividends. Remember that dividend policy applies to ordinary dividends, not preference dividends. Because preference dividends are going to be fixed, so you can't really have a policy when you have a contract that says you pay 10%. That's not a policy. A policy is something that is open to decision making and not necessarily a contract. Right, so as you can see there, it's 450. Again, it's 450. So from what I see here, this, I can say this is going to be a constant payout. Right, so we have a constant payout policy or a stable payout policy where you're going to pay the same amount, right? The same amount, not necessarily the same percentage. So the constant or stable payout. And then if it is a particular percentage that is always being paid, like for example, a percentage of earnings, then we have a constant payout ratio. Then that constant payout is not based on the actual amount, but is based on the ratio. So I think that would forget the actual name, but it has to mention that probably constant payout percentage, right? Not the actual amount. So this will be a constant or stable payout ratio, right? Because we're having 450 being paid, 450 being paid, and we are also required to comment on the sustainability. Here the profits is 798, so we paid 450 regardless, and here we made a loss of 1291 and we still made a payment of 450. So this is being paid regardless. It's not related to financial performance, and over time, that if the losses continue, right? Sorry, let's talk of, no, I was talking of before tax. No, I can't do that. We talk of net profits after tax, right? So this will be this one, not 798. It will be, we will be making a judgment based on the 570. So we could say this going into the future may not be sustainable, because when the entity is making losses, then there may not be sufficient cash reserves to do the payout one. And so if we have cash reserves as well, then now we can have a look at that. But for example, here we had a bank overdraft, so we actually don't have, we're not generating enough cash reserves to make that sustainable. So when we comment about the future sustainability, we're going to focus on our ability to generate profits and cash flows. And then we would conclude to say, over time, if this situation persists, then we will be unable to, it will be unsustainable going into the future, right? Remember, you could have, anybody could come up with their own reasoning, but this is plus or minus what you can expect. This is what you can expect to have been relevant with discussion with the lecturers. Then, based on the principles of capital budgeting, advise this guy whether it will be financially beneficial to acquire MLS TV rights. Here. Use the market values on 3rd September 2024 to calculate work. And you look at that, that's 18 marks, and that's a lot. But capital budgeting, come on, it's always very easy. So this is a mix of capital budgeting and what? And cost of capital. All right. Capital budgeting and cost of capital. So that was quite easy, really, because I was thinking this was a hard portion. But you could pick up a lot of marks. Now let's look at based on principles of capital budgeting. All right, so let's go to those principles, whether it must to acquire MS. So we're looking for acquisition, the portion that talks of acquisition. Right, before we even go to the acquisition, we need to determine the work based on market values. So we will have, first of all, to the first job we have to do is to identify the long-term sources of finance, because work is based on the permanent capital structure, right? Remember, we have to include short-term loans and your bank overdrafts, unless you are told specifically that they're part of the long-term capital structure. Right, so we start with ordinary share capital. We will need the cost of capital and the market value. So it's 2.5, and we come to 1.4. 25 million ordinary shares have been issued. So remember that when we're dealing with, what is this thing called? Market value, we want the market value of issues of shares that have been issued. Sometimes you get shares that are authorized, and you need to pay attention to the ones that were issued, because those are the ones whose market values we are looking for. So we don't look at the issue price, we look at the current market price. So there were 25 million of each worth 100 rand. So this is the issue price. So we need the valuation on the date. So the dividend yield, I've explained this thing before. If you go to if you go to the recordings I shared with you on capital, cost of capital, right? I explained that whenever there's a yield, it has to do with the price. So if it is a dividend yield, there is the price included here. The share price is included. If you have earnings yield, then the share price is included in the yield thing. So the dividend yield is going to be your dividend per share over your price per share. That's the dividend yield. And that's going to give us 14.4%. Right? So the price per share is going to be equal to your price per share is going to be equal to your dividend per share over dividend yield. Right? So if you want, this is the price per share, this is the dividend per share. But the total dividend, if you want, then you can say the market value of all the shares is going to be the total dividend, not dividend per share, divided by the dividend yield. All right. So depending on what we are given, so I think we are given the dividends, right? It's 450, and I don't know what that 450 is. I think that's 450 million. Right, this is million, so that's 450 million. So I will have that as 450 million, 45 million, 450 million, divided by 14.4%. Then I have, my calculator doesn't quite help me because it's scared of long numbers. Then I have 3.125 something. So it's probably 3.125 billion. Right. So that's the market value. And then the cost of equity is going to be equal to, right, your cost of equity. You guys know that your cost of equity. So let's see. Cost of equity is going to be equal to what? D1 over P0 plus G. Right. So then your D1 is going to be equal to D0, is that correct? Plus G, right? I'm rusty. I last taught this 1 plus G, I think. Yeah, I think this is correct. Right. This is your D0 is your most recent known. So this one is the most recent known dividend per share. This is the growth in the dividends annual growth in dividends. Right. So the D1 is the expected, which we do not know yet, but we expect it to be D1. Right, because in this case there doesn't seem to be a change. So your D1 is also the D0. Your G is going to be equal to 0 because there's no growth. Right. Right. So the cost of equity is going to be equal to your D1 over P1. All right. And if you want to, we have the D1 will be the same dividend, which is 450 if this is a constant payout. Then the P1 will be your market value. And of course, that should bring you back to this, it should be your dividend yield, where the dividend doesn't change and over the price. So that must still bring you back to 14.4% in a case where there is no growth. All right. So that's going to be your, what is that thing called? Your cost of equity. And you're going to use that in your determination of your work. Right. Then the other thing we need to, then we identify, so let me, can I delete this because I think we're done with the revenue. Then the other source, ordinary share capital, medium-term loan could be, so let's look at the medium-term loan, but the book value or the carrying amount is 4.5, so that's more likely the book, that's the book value, right? 4.5. So let's look at the medium-term loan, 1.5. So the book value, the carrying amount is 4,500. I think that's million. right? And has a fixed interest rate of 8.5% per annum. So if I multiply that by with 8.5%, then that's going to be my payment. All right. Right. I haven't checked what the tax rate is, so I don't like it, man. There's a lot of scrolling up and down, you know. So where do we have the tax rate applicable here? So you guys would know, you would have seen that, because I really don't want to. Do we have any tax rate applicable? This is your inflation rate. All right, so I'm sorry, but I'm not going to look for the tax rate here. I'm really sorry. You guys have to do that. That's part of your job. You know, I don't want to scroll up and down for something that is basic. Yeah, at least if I was explaining something that you need help with, I would do that. Right, so then, all right, let me see first here. The interest is annually and capital is fully repayable as a single bullet payment on 30 September. Similar loans are offered at 7.15%. So you multiply this by 1 minus the tax rate. All right. So here is a case. I've taught you that in something that is redeemable, all right, if we have a date of redemption, right, we have a date of redemption, then we can use this formula where we have a payment, what's that? Future value is going to be equal to the 4.5 which you're going to pay in the future, right, at redemption, and the number of payments left. So I don't know which year we are in. Is it 2024? All right, maybe it's 2024. All right, now 2024 to 2027. So my N is going to be equal to 3. Then my interest, or my cost of equity, not cost of equity, cost of the loan is going to be equal to 7.15%. For similar loans in the market, because the cost is in the market. And because it's pre-tax, I have to adjust that for taxation by saying 1 minus the tax rate. Right. Then 1 minus the tax rate. Then I have then from all these calculations, I can determine my present value, which is the market value that I'm looking for. So I already have my cost of the medium-term loan, but I have to adjust that for tax. Then my present value will also be like that. Right, so we said that this is a case when we have the redemption date. In a case where we don't have the redemption date for a loan, we said, just say your finance costs over the, what's this thing called? The cost of the loan. So you can put in the finance costs. I want you to adjust for tax. You can still not adjust, but I want you to be consistent. So your finance costs 1 minus tax divided by your cost for in the market cost for similar what's this thing called? Cost for similar instruments in the market. All right, 1 minus the tax rate. Then this is going to be your approximation of the market value if we don't have a redemption date. But where we have a redemption date, then we're gonna use this. Or we can also use the cash flow formula where you say CF0, CF1, CF2, CF3, and all that together. You can also do that. We explained everything to you in previously. Right, what else do we need to value here? After valuing what happened? Are we here? Right, so we had non-interest, so this one is all out, right? Then we have preference shares, 6%, and the nominal value is what? 50 rand each. So we can determine the number of shares here, can't we? If we have 5, whatever, I think that's 5 billion over 50. So we might have 100 million or something like that. And then the 6% is the coupon. All right. So if you have forgotten these things, remember this is very broad, right? The principles of financial management are very broad. If you've forgotten this, please go to the notes that we shared with you as you prepare your supplementary. It's really important, right? We cannot exhaust everything that we already spoke about. So the market value is given, right? So we can calculate the cost because we have a redemption date. So the present value is the market value, which is 4.9, and that's the present value. The future value is the redemption date, the redemption value, which is 4.5 multiplied by 1,02, because we're going to add a 2% premium. Then N is going to be equal to 5 years from now. Then the payment, remember that the payment for preference shares is not adjusted for tax. So the payment is 6% of 4.5. Then from here you can calculate the rate, which is the your interest rate, or which is going to be your cost of preference shares. So if I would go to the calculation that was done, so this is some of the attempts that were done, so you can perhaps look at that. Right, this is the inventory. Right, that's the constant payout. Right, so we did this, and the market value of equity is that, and the cost of equity is that. Then the medium-term loan, this is what we did. If you look here at my calculation, I didn't include the tax rate, simply because when calculating the present value, taxation is not going to affect the present value. But I said to you, I want you to be consistent and multiply by the payment has to be adjusted for tax, and this interest rate also has to be adjusted for taxation. I said I want you to do that for consistency. Then this is what I got for for the market value. All right, you can get a different one, but that's the principle to follow. All right, so maybe the tax rate is 27% there. I just didn't want to go up, and look for it, but looks like that's the case. So that's the true cost of preference of the medium-term loan. So we have the market value and the cost. Then preference shares, that is what we have. Market value, having calculated the future value as that. What did I do? Is it 5 million? Oh yeah, it is 5 million. My apologies. So I was actually making a mistake earlier to say 4.5. It is 5 million for it is 5 million for preference shares. So then the future value will increase. We will have a premium of 2%. N is equal to that. The present value is given. Then the payment is 6% of 5 million. Then the interest, I got it as this. Just need to remember that you don't adjust for taxation for preference shares, right? And also remember that you use this formula if you have the redemption date. If you don't have the redemption date, then you're going to say preference dividend over the dividend yield, or the preference dividend over the cost for similar preference. Preference dividends over the cost for similar preference shares in the market. Then that gives you an approximation of the market value in a case where we don't have the redemption date. And I said to you, I want you to be comfortable with the I want you to be comfortable with using the cash flow formula, right? Cash flow 1, cash flow 2, cash flow 3, and so forth. Because sometimes you get given a question where the payments are not consistent, the inflows or outflows of cash are not consistent, and you cannot use PMT, because PMT you use it when you have a consistent payment inflow or outflow. But where you don't have a consistent over the years, then you need to be able to use this valuation technique. Right, so this is going to be whatever you get. All right, this is what I got, but whatever you get, it's all right. You have to apply that. Then what are the principles here? Let's go to the, what's this thing called? this acquisition. So there are principles of capital budgeting that we have to look for. Is it a long question? All right, so I think this is, so it's quite short, right? So following this, so they're going to consider investing in this for 4 years. So which means that in your capital budgeting, you have year 0, which is now 1, 2, 3, 4, right? Starting from the beginning of 2025. So the big cash flows required in the beginning of 2025 financial year are going to be part of year 0 finance. So the initial outlay will be 60, so it's an outflow. And what? Right, costs. Then 1.5 million for marketing costs is also required upfront, right? I don't see this any of this as a sunk cost. Now, one thing that I want to remind you is that when you have these marketing costs, they could be tax deductible. Right. So which means that when you do your tax calculations, remember to move them to, for the purpose of tax calculation, remember to move them to year 1 to deduct them from the taxable income for year 1. Then 50 million in revenue per year. Right, so that's easy. So we're gonna start here 50 all the way. Then variable cost 26 for what? For first 3 seasons, so 26, 26, 26, which is an outflow. All right, and 27.5 in the final year. The tax write-off or similar intangible assets is 3 years on a straight line basis. So we can do, as it were, that's not where we can do capital allowance for that. Right. So I think that's quite easy. I really don't know if that is everything. So let me have a look at the things that I did. I think that was quite simple. So the rights is going to be there, the revenue, that's the revenue, right, is given. Then the taxation at 27% is based on the revenue, right. Then this is the costs. Then marketing, remember I moved this marketing because it's incurred at the beginning of the year, but for tax purposes, you have to move it to year 1. Then wear and tear capital allowances, is we're going to claim that. So before tax is 2.5. 4 and 22.5. Okay, yeah. So here you also need to just be careful that the capital allowances for the rights is just for what is that? For 3 years only. Right? Then you're gonna get your taxation at 27%, which is 27% of that. All right. All right. Then we get our after tax cash flows. Then that's going to be your CFs and like that. Then you calculate your NPV at 8.11%. So remember here, I'm so worried about this module because this module has a room for a lot of errors, and I don't really think that the markers will follow through on an error. And one of the things that they do, these guys, is that they will never tell you they'll never give you the memo, because once you have the memo, you can obviously dispute better your marks, but you can get the memo, then purchase your paper and dispute. So probably that's the reason why they won't give it to you. But this was a rather straightforward question, really. Then we move to one of the questions. Right, so one of the questions, this is done. So one of the questions says, discuss possible reasons why LC would have considered the 2 valuation techniques below to be less appropriate in determining short-term valuation. The Gordon dividend growth, obviously. I don't know. Is it the same question where there was no growth? Right, so I won't really answer the question directly. I will just talk about when are those questions, when are those valuation techniques applicable. You can also look in the your textbook lists the circumstances under which you can apply each, and in the notes that I shared with you, we also explained when each valuation method is going to be valid. So you will need to so this one will require historical dividends. So we need to check, do we have those historical dividends? And it also requires a predictable pattern of growth. You should be able to predict. It can't be up and down, because remember, you need D1, you need D1 based on D0, the previous one, and G is based on growth. And also the entity should be giving, should be issuing dividends. So it can be a case whereby the dividends, there are no dividends this year, and then next year there are, then there are no dividends again, and so forth. So you have to check, do we have a history of dividends? Do we have a growth pattern of the dividends? All right. Then the price earnings multiple works if we are making profits. So in a case where we're making a loss, then how do you value a loss? So we need to be making profits, and the profits should be consistent. All right. Right. So if you look, you have to check, and the profits have to be consistent. All right. And what else? We need also a comparator entity. So you have to check, do we have that comparator entity for which we can try to make an estimate of? Okay. Right. So you can get your, it's actually two reasons, 2 marks. So it's 2. All right. So that's quite fair. Then as part of due diligence, discuss the conceptual errors. Right, at least that's the last one, because I'm tired. Discuss the conceptual errors in the acquisition of Canal Plus. Right, so let's go to the conceptual errors, and I'm going to sign off. Right, so we want to acquire 90% of the equity. Right. Then the calculation here was done using the free cash flows. Let me see. Right, so LC considered various valuation techniques and eventually decided that the free cash flow would be the most appropriate. Then this is calculation of present value or the market value using free cash flows. All right, so you really need to know the principles of free cash flow valuation for you to be able to critically evaluate what someone is doing. So the concept of a free cash flow is that we need to convert accounting profit, right, to a cash flow, because we have accounting income, and in that accounting income there will be non-cash income and non-cash expenses. All right, so we need to reverse them. So if there's a non-cash income, like a fair value gain on investment property, so there was really no cash flow, right? It's just a paper adjustment. Here we're looking at the actual cash flows coming in. So we have to reverse any gains which are not cash flow. Like a profit on disposal is not the actual cash flow that you get. So you have to reverse that to the actual cash that was received. Remember that. And non-cash expenses, your usual culprits, your depreciation and amortization. Right, so let's look at here. When I looked at this, it was so irritating, you know. It was so irritating because there's a lot of mistakes and you can't really make such mistakes. Right, financial year 2024, 25, 26, 27. So your current year is financial year 2024. It can be CF1. CF1 is the following year. So that's going to be the first error here. This is supposed to be CF0. And remember, the CF0 is not really relevant because we're valuing cash flows into the future. But we might want the cash flows for the current year because cash flows for the future years might be based on current cash flows, like a growth of so much. But this will be CF0, the current year. All right, so that's one error. That it says to be CF0. And net profit or loss adjustments. This is boring. Right, so we have to add back depreciation and amortization. That's 3. The 20 million rand addition to depreciation and amortization charge from 2025 relates to the amortization of the 60 million rand capital investment in the MSL TV rights. The amortization and tax rate of periods are the same, right? So let's see what they're doing. So there's an extra 220. Right, so this has been added back as it is. It should be adjusted for tax, right? So we must reverse it, because remember here we're dealing with net profit for the year, right? And so net profit is after tax. So which means that if we adjust an amount, if we are going to adjust this amount here, all the amounts we're going to deal with should be after tax. If it was profit before tax, then we would have to adjust amounts without netting them of taxation. So here, the fact that they just add it back without adjusting for taxation is not accurate. Then now obviously we go there, then we get gross cash flows. The question says, look for what? The question says look for conceptual errors. So which means that we don't have to, this is what I wanted to, we don't have to reperform calculations or arithmetic accuracy, right? So we're just looking at the conceptual errors, because I was going to check if this is correct. So if they don't say do not recalculate, you always have to recalculate to make sure that the actual addition subtraction is done correctly, right? The arithmetic is done correctly. Then gross cash flows 3.2. What does this say? 3.2 says then F for the 2027 is expected to be 5.5% higher than 2026, and will also annually grow at this rate. Gross cash flows will grow at that rate. All right. Right. So one of the things is that this is going to be CF0 if this is necessary, and also picked up here that the taxation, this should be adjusted for taxation. Then now we come to what? I'll come to gross cash flows here. All right. So this is 880. This is 945. This is 2052. All right. Let me see. Then we have net working capital movement. All right, okay. Then free cash flows is going to be 650, 620, and that amount. All right. I'm trying to figure out where else there might have been errors. Then continuing value. Remember, there's a growth rate, so the growth rate should be included in the discount rate. If we have this as the work, so what is this 15% here? 3.2 and 3.4. So the work is 15%, all right. But then the growth rate of 5.5% is not adjusted here. So this will be another error where the discount rate used is not adjusted for the growth rate in the cash flows. Right. Free cash flows. So what is this continuing value? How is it calculated? 2052. Okay, so 2052 is the gross cash flow for 2027, and we have been told that so from 2027 onwards, then it's going to grow at 5.5%. So the continuing value can't be the one for 2027, all right? For 2027, the continuing value should be from 2028 onwards. So which means that we need to grow this by 1.05 first before we discount it, right? And then when we discount it, we have to put it in this current year, 2027, the present value, not in this year, right? Then I don't know if there's anything else I might have missed there, because there could be a lot of errors really, and I might have missed some of the concepts. Then where is the rest of the function? Oh, that's all right. So we go all the way. Okay, that's fine. Then the value of the operations, there is what we have. Then adjustment for debt, 3.6. So we should use the fair market value of debt, which is 999220, not the book value, right? So that's a conceptual error as well. That was done. And okay, there we are. And then they have minority discount and control premium. Here we don't have minority discount because I think they're acquiring 90%. So this will be only a control premium will be applicable, right? Not a minority discount. So this is also wrong. I'm not sure if the marketability discount is given, because sometimes they give you that a listed entity trades at a certain right. Let's see. But sometimes they tell you that a listed entity trades at a certain premium above an unlisted entity. So that's going to be your marketability discount. But in this case, it doesn't look like we have that. And then also here, we don't need the value of, we don't need the 51%, we need 90% of that, not 51%. So those are some of the things that I managed to pick up. I don't know what else. There could be a lot that I just didn't see, but I think that will be sufficient. So basically that was the discussion of the paper, and the financial management is easily a problem. It's very broad, but it's quite doable as well. Alright, so should you have any questions, you can ask in the class, and I wish you the very best in your preparations for your supplementary exams. And remember that we did a lot of previous past exam papers. So what you can do is just, why don't you rewrite those papers that we did? Just sit there. You don't really have to pressure yourself by writing according to the time requirements. I want you to write, let's say maybe 4 hours, so that you should be able to finish. Then I want you to test your knowledge. Then after writing up those past exam papers we did, then you can compare with the feedback that we gave you, right? And then that should be fine. So once you've gone through all the papers for costing, I think altogether, if you combine the costing papers and the finance management papers, we probably covered 15 past exam papers, including for the semester modules. And that should be sufficient to guide you. So I wish you the very best in your upcoming sub exam.